I think there's a couple things on the table there. One, we have U.S.-China trade, like we talked about, still out there. December 15th is still a key date. We don't know clarity or don't have clarity around that. And number two, it's interesting, since they last met, we've had this shift in market sentiment that perhaps we're in this bottoming process in the economy. Perhaps next year we'll see a mid-cycle reflationary story. And so I'm wondering if the Fed is also, alongside the rest of us, watching to see if the data proves that out. And I think that will be key. We talked about PMIs earlier. We'll be watching to see if those stabilize, not only in the U.S., but globally. So I think the Fed is watching the U.S. global economy, trade, just like the rest of us, and any material deterioration or appreciation will cause them to move.
Going back again to that CNBC Fed survey, we saw confidence in even a limited trade deal falling. It was 83% in September, 54% in December. How crucial is trade to what we will see unfold over the next year?
I think it's very crucial. And the problem is that I think the best we can hope for here is a fragile ceasefire rather than a durable peace. And that's really the problem, because global business is holding back on investing because they don't know what the rules are going to be around trade. And I think that the administration seems to think that, if the markets go up on rumors of a trade deal, that's a positive. I think the real positive is having some certainty around that. I think you have to get past the 2020 election for that. So I think that's going to be an anchor on both global interest rates, frankly, and on the global economy over the next year.
Well, if you look at these, go ahead, Scott.
I was just going to say, most people I talk to think that there's mostly downside risk on trade, in part because they think the damage that's been done to the economy from trade is already done, and the question is, does it become worse? The expectation that Contessa was talking about for a limited trade deal, most people I talk to don't think there's too much economic benefit of that other than eliminating downside risk, because a limited trade deal isn't going to get rid of the prior tariffs, is the thinking out there. And that means that the damage has been done for 2020, or at least the first half of it.
We've had those tariffs now for, 2 years? I mean, at some point, when do you start thinking this is just the way things are? I mean, you can't just keep waiting. I mean, the definition of insanity is doing the same thing over and over again and hoping for a different outcome, Jim. I want to quickly get to the repo thing, because we talked about it just a little bit, and we've been digging into it. Some people think it's nothing. Some people, a couple people, think it could be everything. Where do you stand?
I stand closer to everything than nothing. It is something, for sure. I mean, liquidity in the markets and the proper market functioning, I think, is absolutely critical. And I think this is a
former Federal Reserve strategist who's now a strategist at Credit Suisse, named Zoltan Pozsar, put out a note effectively saying a couple days ago that it's going to spike yields and it's going to screw up the FX market, which is going to send stocks crashing.
Well, if things aren't addressed, that can certainly happen. But I'm glad.
It could.
Right. It could,
you agree those things could happen.
Without doubt.
Sort of the dominoes going dunk, 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 dunk.
Liquidity, it all starts in the repo market, right? If you can't get financing, which is the base rate of the market, that creates a problem. So that's what the financial crisis was all about, was really a loss of financing. But now let me talk about something here, because I want to change course a little bit. I'm very uncomfortable with this Fed statement, and even with the way that things are being addressed right now, because effectively what the Fed is saying is they're going to let the economy run hot. Okay, that sounds great, but I'm a fixed income investor. So what does that mean for me? Does that mean that we allow inflation expectations to move higher? Do we allow interest rates to move higher?
It means you're a wimp. That's what it means.
Oh, gosh.
And if fixed income investors have been wimps for a very long time, you do not ask for inflation compensation. You continue to buy U.S. bonds that trade at real negative rates, and you will take what you're given, I think, is what the U.S. government is saying and what's been happening here. The Fed, I think, is following the market on this. And I mean no disrespect. I'm just kidding around here. Yeah. The market has been taking down $1 trillion plus of U.S. debt at a negative real yield, not demanding inflation compensation. The Fed has followed this, and the idea is that it doesn't see the inflation out there. Neither apparently does the fixed income market.
Steve, let me just kind of I mean, look, we have investment grade, which is up about 14% right now. You have high yield, which is up 12.5% this year. This is a great year for fixed income. Treasuries, are up very, very, much as well. A lot of that is because the Fed had this mid-cycle reset and pushed rates down, which is great, and I think it was appropriate, and that's totally fine. What about next year? You mentioned financial conditions earlier and what the Fed's reaction function is. What if, for example, we don't just get a 20, 25 basis point move higher in yields? What if it's closer to a 50 basis point move higher in yields? And that unravels a lot of what the Fed has done this year in terms of easing financial conditions. Yes, the bond market, we're big boys, we can take it. But I think a lot of passive investing that's in the markets right now are going to be very, very upset and disappointed. And given the fact that equities and fixed income have become very highly correlated, if we remember back to this time last year, the Fed was very, very nervous when the equity market started to fall. And I would argue that if interest rates move high enough, that would cause that domino effect to actually start to move. So I think within a band, if rates go up 20, 25, 30 basis points, no big deal, we can handle that. If the number's more like 50 or 75 basis points, then I think it becomes more of a system-wide problem across financial markets.
But I actually don't see it that way, because the problem is these bonds are valuable if rates are falling. You can see a capital gain. Once you settle at these low rates, I mean, it is a miserable yield across the Treasury curve and in cash. It's all of it below CPI inflation. And if you don't see a path downwards on rates, then I think that is going to continue to funnel money to the U.S. equity markets. You're not making money in cash. You're not making money in bonds. You're scared of the rest of the world. And that's really what I think has been behind the lift in the U.S. equity market all year long. And I think that just continues in 2020.